Are Lululemon and Target retail stocks worth buying and holding? The retail industry is a volatile sector, and two stocks that have recently fallen out of favor are Lululemon Athletica, NASDAQ Lulu, and Target, NYSE TGT. After a rough 2025, both companies have seen their stock prices drop by more than 40% over the past 12 months. But is this a buying opportunity for long-term investors? The headwinds for Lululemon and Target. Lululemon, a high-end athletic apparel specialist, has been hit hard by weak U.S. demand and higher trade costs, which have pressured its profits. The company recently cut its outlook and noted the need to strengthen its U.S. assortments and accelerate product newness. Target, one of America's largest general merchandise retailers, has also been struggling. The company continues to face soft discretionary spending and thinner margins as consumers stay cautious and tariffs weigh on results. In addition, Target's digital services and advertising unit have been gaining traction, but the company's overall financial results have been disappointing. The silver linings. Despite these challenges, there are some silver linings. Lululemon remains a powerful global brand with expanding reach in markets like China, while Target's digital services and advertising unit continue to gain traction. Both companies are adapting their strategies rather than standing still. Lululemon, international strength and product innovation. Lululemon's second quarter of fiscal 2025 showed both pressure and resilience. Revenue grew 7% to about $2.5 billion, with comparable sales up 1%. International expansion continues at a healthy clip, supported by new stores and rising brand awareness, particularly in China. However, earnings per share slipped to $3.10, down from $3.15 in the year-ago quarter. Target, meaningful sequential improvement. Target, which boasts nearly 2,000 stores, reported disappointing quarterly results. In fiscal Q2, Target's net sales fell 0.9% and comparable sales declined 1.9%. However, under the surface, several key drivers moved in the right direction. Management said both traffic and sales trends improved meaningfully compared to the first quarter of fiscal 2025. Additionally, digital comps rose 4.3% on more than 25% growth in same-day services like Drive Up and Target Circle 360 delivery. The case for buying and holding. Despite the challenges, both stocks are trading at dirt-cheap valuations that price in bad news and arguably ignore some key catalysts for both companies. Lululemon's faster product cadence and strong international growth are clear reasons to consider buying the stock. Meanwhile, Target's dirt-cheap valuation and double-digit growth in high-margin businesses help offset concerns about a weak consumer and tariff pressures. Should you invest $1,000 in Target right now? Before you buy stock in Target, consider this. The Motley Fool Stock Advisor analyst team just identified what they believe are the 10 best stocks for investors to buy now. Target wasn't one of them, but the 10 stocks that made the cut could produce monster returns in the coming years. Consider when Netflix made this list on December 17, 2004. If you invested $1,000 at the time of our recommendation, you'd have $646,805. Or when Nvidia made this list on April 15, 2005. If you invested $1,000 at the time of our recommendation, you'd have $1,123,113. Now, it's worth noting, Stock Advisor's total average return is 1,055%. A market-crushing outperformance compared to 188% for the SP 500. Don't miss out on the latest top 10 list, available when you join Stock Advisor.